People always ask me, Jim, how did you consistently make 66% returns per year? And honestly, if there's one thing I've learned, it's that extraordinary results aren't about luck. They're about patterns, discipline, and a relentless curiosity about how the world really works. When I started Renaissance, I wasn't trying to be famous or impress anyone. I just wanted to understand the markets in a way that no one else seemed to. I treated numbers like clues in a puzzle, and every day I asked myself, what can I uncover that others are missing? People often think that extraordinary returns come from luck or being in the right place at the right time, but that has never been my experience. What really makes the difference is understanding patterns in the world around you and having the discipline to act on them consistently. When I started out, I wasn't chasing headlines or trying to prove anything to anyone. I was simply curious about how the world works and how financial markets behave when you look at them closely enough. I treated every piece of data as a clue and every number as part of a puzzle. There's a certain satisfaction in seeing a pattern emerge where others see randomness, and that satisfaction, combined with rigorous analysis, is what sets successful strategies apart from pure chance. I quickly realized that people who rely solely on intuition often miss the subtle signals hidden in the noise. They make decisions based on what feels right in the moment, but the markets don't operate on feelings, they operate on probabilities, interactions, and patterns that repeat in ways most people overlook. So I decided to do things differently. I built systems to detect patterns that are invisible to the naked eye, and I spent countless hours testing them, refining them, and making sure they weren't just flukes. That's where discipline comes in. It's easy to see a promising opportunity and jump in, but if you haven't tested your assumptions or verified your approach, you're gambling, not investing. Discipline means sticking to the process even when it's tempting to follow your gut or the latest trend, and over time, that discipline compounds into remarkable results. Curiosity plays a huge role too. I'm naturally inquisitive, always asking questions like, why does this happen? Is there a hidden pattern? What have others overlooked? That curiosity drives you to dig deeper, to challenge conventional thinking, and to uncover insights that can't be found by simply following the crowd. And the combination of curiosity, pattern recognition, and disciplined action creates a feedback loop that reinforces itself. The more you observe, test, and refine, the better you become at spotting opportunities and avoiding mistakes. I think that's what people miss when they try to replicate high returns without the underlying approach. It's not enough to copy trades or strategies. You have to understand the principles behind them, the logic that connects data to decisions, and the patience to stick with them over time. That mindset, valuing patterns, embracing curiosity, and committing to disciplined execution is what separates those who consistently achieve extraordinary results from those who chase luck and hope for the best. People often tell me, Jim, you must have a special intuition that allows you to predict the market. And I have to laugh because intuition alone doesn't get you anywhere near consistent returns. Intuition is what our brain produces after the fact. It's a story we tell ourselves to make sense of randomness. In reality, if you want to achieve extraordinary results, you need something far more reliable than your gut feelings. You need data, patterns, and rigorous testing. When we first started building our strategies, I knew that no single human mind could process the sheer volume of information or spot the subtle correlations that existed across markets. So I focused on building systems that would analyze millions of data points, test assumptions thousands of times, and reveal patterns that a casual observer would never notice. It wasn't glamorous, and it certainly wasn't fast, but it was far more effective than any hunch. What many people don't understand is that the market is a complex system. Prices move not just because of supply and demand, but because of countless interactions between participants, news events, and even seemingly random occurrences. If you try to rely on intuition alone, you're essentially trying to predict the outcome of millions of variables in real time, and that's impossible. The edge comes from building models that capture regularities within that complexity and then being disciplined enough to act on those models. Testing is critical. You can have a theory that seems brilliant on paper, but until you run it through exhaustive simulations, until you stress test it under different conditions, you can't be sure it will hold up in the real world. Early in my career, I learned the hard way that relying on untested ideas can lead to devastating mistakes. That lesson shaped everything we did at Renaissance. We didn't just ask, does this make sense? We asked, can this survive thousands of trials under varying conditions with changing markets? And if the answer was no, we didn't pursue it. That kind of rigor sounds tedious, but it's what separates consistent success from random luck. Another critical point is humility. No matter how brilliant you think your intuition is, the market can and will prove you wrong. Patterns that seemed obvious can disappear, correlations can break down, and strategies that once worked can fail. By grounding decisions in tested data rather than feelings, you remove emotion from the equation. Fear and greed, which destroy so many investors, have much less power when your decisions are based on robust analysis rather than impulsive judgment. The real advantage of focusing on data and testing is that it allows you to uncover patterns invisible to the naked eye, small inefficiencies, repeated behaviors, subtle correlations. These are the opportunities that compound over time. And because your decisions are validated through rigorous experimentation, you have confidence to act decisively when the moment arises without second-guessing yourself. That confidence, grounded in empirical evidence rather than gut feeling, is what allows a strategy to scale and produce extraordinary returns. Over the years, I've seen countless people fail because they trusted their intuition instead of their models, chasing quick wins or reacting emotionally to market noise. By committing to testing, by relying on data, and by following disciplined, repeatable processes, you create a system that works consistently even when the market seems chaotic. One thing I've learned over the years is that mathematics isn't just a tool, it's a language that reveals the hidden structure of markets. Most people misunderstand risk. They see volatility as risk, thinking that big swings in prices are inherently dangerous, but that's not how I look at it. True risk is the chance of making decisions based on flawed assumptions or incomplete understanding. It's the risk of misreading patterns, of trusting your intuition when the underlying system is too complex to comprehend at a glance. That's where mathematics comes in. By deeply understanding probability, statistics, and the way randomness behaves, I can separate noise from signal and make decisions that have a much higher likelihood of success. Early in my career, I realized that without a rigorous mathematical foundation, even the best ideas could fail. Markets are full of illusions. Trends appear where none exist. Correlations vanish when you need them most, and luck can masquerade as skill for a time. Math allows you to quantify uncertainty, test ideas systematically, and recognize when an observed pattern is real versus when it's just coincidence. That insight changed everything for me. I began thinking not in absolutes, but in probabilities. Every trade, every strategy, every model was evaluated in terms of expected outcomes, likelihoods, and risk-adjusted returns. I wasn't guessing, I was calculating, constantly asking, given what I know, how likely is this to succeed? How much could it cost if it fails? And when I applied this approach consistently, the results were staggering. It's also important to understand that mathematical models are not infallible. They have limits, assumptions, and blind spots, and the moment you forget that, you expose yourself to unnecessary risk. That's why every model we built was continuously tested stress-tested, and updated. We wanted to ensure that it captured reality as accurately as possible and that it remained robust under different market conditions. Another crucial lesson is that subtle patterns exist everywhere, but without a mathematical framework, they remain invisible. Small correlations, recurring behaviors, inefficiencies that seem insignificant individually, they add up. By measuring, analyzing, and compounding these small edges, you create the foundation for extraordinary returns. And the beauty of math is that it removes emotion from the decision-making process. Fear and greed, which wreck so many investors, have far less influence when your actions are based on numbers, probabilities, and well-tested models. It gives you the confidence to act decisively even when the market seems irrational or chaotic. People often ask me if I ever rely on instinct, and the truth is, instinct can mislead you more often than it helps. What I rely on is a structured, quantitative understanding of the world combined with disciplined execution. That combination, guided by mathematics, allows you to see opportunities that others cannot, to manage risk intelligently, and to make decisions that compound over time into extraordinary results. Without that mathematical rigor, it's easy to be swept along by market noise, to chase trends, or to misjudge probability, and all of that undermines long-term success. Learning to think mathematically transformed the way I approach investing. It turned a chaotic system into something I could analyze, model, and act upon reliably. One lesson that became incredibly clear to me over the years is that no one can do this alone. The markets are far too complex, the patterns too subtle, and the data too vast for a single person to process effectively. That's why building a team smarter than yourself isn't just helpful, it's essential. I've always believed that if you surround yourself with people who challenge your assumptions, who question your ideas, and who push you to think differently, you'll achieve results that would be impossible on your own. At Renaissance, I made it a point to hire mathematicians, physicists, computer scientists, and analysts who were exceptionally curious and unafraid to speak their minds. I didn't want people who simply nodded along with me or agreed with every decision I made. I wanted people who would argue, who would challenge, and who would force me to examine every assumption and every model. That kind of intellectual rigor is what separates mediocre results from extraordinary performance. Collaboration is a superpower. Alone, I might see a few patterns, spot a few correlations, but together with a team of sharp minds, we uncovered insights that no individual could see. Ideas bounced off one another, weaknesses were identified before they became problems, and strategies were refined to a level of precision that would have been impossible by myself. The synergy of a strong team magnifies every advantage. And it's not just about hiring smart people. It's about creating an environment where they feel empowered to speak up and contribute. I wanted people who were passionate about discovery, who were willing to spend hours testing ideas, analyzing data, and challenging conventional wisdom. That passion, combined with talent, creates an atmosphere where innovation thrives and where the best ideas rise to the top regardless of who originally proposed them. Another critical aspect of teamwork is accountability. Everyone on the team knew that decisions would be scrutinized, models would be tested, and results would be evaluated rigorously. That culture of accountability ensures that mistakes are caught early, that assumptions are constantly questioned, and that every strategy is continually refined. And in that environment, fear and ego have less influence. When decisions are based on evidence and collaboration rather than individual pride, you can act more decisively and avoid costly errors. The other thing I've learned is that collaboration fosters learning. I was always learning from my team, from their perspectives, their methods, and their unique ways of thinking. That constant exchange of ideas keeps your mind sharp, your models robust, and your strategies ahead of the competition. People often ask me how we achieved returns that seemed impossible to the outside world, And the answer is simple: no one person did it. It was the combined intelligence, curiosity, and discipline of a team working toward the same goal, constantly challenging each other and improving every idea. That kind of collaborative environment, built on mutual respect, shared curiosity, and relentless rigor, is what allows extraordinary performance to emerge consistently over time. Without a team like that, even the best strategies, the sharpest insights, and the most sophisticated models are far more likely to fail or underperform. One of the most important lessons I've learned in investing is the value of humility. It sounds simple, but it's astonishing how many people ignore it, thinking they know more than they actually do. I've always approached markets with the understanding that no matter how brilliant I am, no matter how sophisticated my models are, there are always things I don't see and situations I can't predict. That awareness is what keeps you alive in the long run. When you stay humble about what you know, you constantly ask yourself, where could this fail? What am I missing? What assumptions am I making that might be wrong? That mindset forces you to examine every model, every strategy, and every decision with a critical eye. It's not about self-doubt, it's about self-awareness. The moment you stop questioning your assumptions is the moment you start making costly mistakes. Early in my career, I saw people get overconfident because a few trades or strategies worked well. They thought they had discovered a secret formula, and that overconfidence led them to take risks that were completely unnecessary. Markets have a way of humbling even the smartest people if they lose sight of the limits of their knowledge. I never allowed myself or my team to fall into that trap. Every model we built had explicit limitations. Every strategy we deployed was stress tested against worst-case scenarios. We asked ourselves, if this fails, how badly could it fail? Are we prepared for that? That level of preparation comes from humility, from recognizing that no model, no matter how sophisticated, is perfect. Humility also encourages learning. When you admit that you don't know everything, you stay open to new ideas, new data, and new methods. I've always been fascinated by the possibility that someone, somewhere, could discover something I had overlooked. That curiosity drives you to continuously test and refine your approaches, and it prevents complacency. Another aspect of humility is understanding the limits of prediction. Markets are influenced by countless variables, some predictable, many not, and assuming you can control or foresee all of them is a dangerous illusion. Instead, I focused on what I could measure, what I could model, and what I could test. I accepted that uncertainty is inherent and built systems to manage that uncertainty rather than pretending it doesn't exist. Humility also helps in decision-making under pressure. When you recognize that you don't have perfect knowledge, you are more cautious, more methodical, and less prone to impulsive reactions. You rely on the process and the data rather than on ego or guesswork. That restraint, over time, compounds into far better outcomes than taking wild bets based on confidence alone. Finally, humility fosters a culture of rigorous questioning within your team. When I hired brilliant mathematicians and scientists, I made it clear that no one, not even me, was above scrutiny. That culture of mutual respect and critical examination allowed us to catch mistakes early, refine strategies continuously, and ultimately outperform competitors who were overconfident and less disciplined. Recognizing your limitations isn't weakness, it's a strength. It's what allows you to build robust models, make sound decisions, and survive and thrive in a market that is unpredictable, complex, and ever-changing. Patience is something people underestimate in investing. Everyone wants quick results, immediate success, but that's rarely how extraordinary performance is achieved. I've learned that compounding works quietly and steadily, and it demands patience and trust in the process. When we developed strategies at Renaissance, we didn't expect instant perfection. Some approaches took months or even years to reveal their true potential. There were moments when a model looked mediocre, when the results seemed slow or inconsistent, but the key was to understand why and to trust the rigor behind it. You have to separate short-term noise from long-term signal. The market moves every second, and prices swing for countless reasons, many of which are irrelevant to the core patterns we were studying. If you react impulsively to every fluctuation, you destroy your own strategy. Patience allows you to wait for the data to confirm your approach, to let the models work as intended, and to let small, consistent edges compound over time. Another aspect of patience is emotional control. Human nature makes us want to act when we see opportunities, when we fear losses, or when we're chasing trends. I've seen countless investors give up on a strategy too soon because of short-term setbacks or because they doubted themselves. Patience is the antidote to that impulsiveness. It allows you to follow a disciplined process, to act only when the model signals, and to resist the urge to second-guess yourself. Compounding is powerful, but only if you give it time. A small edge applied consistently will grow exponentially over years, and that growth often surprises people because it's invisible in the short term. I've always reminded my team that the real magic happens when patience meets precision. You can have the best models in the world, but if you abandon them too soon or constantly tweak them based on temporary results, you destroy their potential. The discipline to wait, to let the system operate as intended, and to trust in rigorous testing is what transforms good ideas into extraordinary outcomes. Patience also fosters resilience. Markets will always challenge you. There will be periods of underperformance, unexpected volatility, and events you didn't anticipate. If you have patience and a process you trust, those moments don't become disasters. They become learning opportunities. You study what happened, adjust if necessary, but you don't panic or abandon the fundamentals. Another reason patience is essential is that it allows you to gather more information, more observations, and more evidence before acting. The more data you have, the more confident you can be in your decisions, and the more likely your actions will produce the desired results. Impatience leads to guesswork, overtrading, and exposure to unnecessary risk. True returns come from a combination of meticulous preparation and the willingness to let the system play out over time. I've seen strategies that looked insignificant at first become major contributors to our performance once we allowed patience and persistence to do their work. That experience reinforced a lesson that I carry with me to this day. Extraordinary results are rarely instantaneous. They require trust in your models, trust in your team, and trust in the process. And when patience is applied consistently alongside discipline, mathematics, and careful observation, it compounds into something far greater than any single action could produce. Innovation is something I've always treated as a necessity rather than an option. In markets, nothing stays the same for long. Technology evolves, regulations change, competitors adapt, and patterns that once worked can disappear almost overnight. If you're not constantly innovating, you fall behind, no matter how brilliant your previous strategies were. From the very beginning, I approached investing like a scientific experiment. I was never satisfied with the status quo, and I encouraged my team to challenge assumptions and explore new ideas relentlessly. We asked ourselves, what haven't we tried? What data haven't we considered? What patterns might others be missing? That mindset kept us ahead of the competition and allowed us to uncover opportunities that seemed invisible to everyone else. One of the most important aspects of innovation is curiosity. You have to constantly ask questions, not just about what the market is doing today, but about what it could do tomorrow and why it behaves the way it does. That curiosity drives experimentation, and experimentation is where real progress comes from. It's about testing small ideas, refining them, and then applying them at scale when the results are proven. Another element of innovation is being willing to break away from conventional thinking. Most investors follow trends, rely on intuition, or stick to familiar strategies. But extraordinary performance comes from seeing the market differently. You have to be willing to look at the same data everyone else sees and ask, what patterns are they overlooking? What relationships exist beneath the surface that aren't obvious? That's how you create an edge. Innovation also requires a tolerance for failure. Not every idea will work, and if you're too risk-averse or afraid of mistakes, you'll never experiment enough to find the breakthroughs. At Renaissance, we treated failure as information. Every model that didn't perform as expected taught us something, and every unsuccessful experiment refined our understanding of the market. You have to embrace that learning process. Another critical point is speed. Innovation matters, but timing matters too. Markets evolve quickly, and the advantage of a new idea can evaporate if you don't implement it efficiently. That's why building systems that allow ideas to be tested, analyzed, and applied rapidly was essential. We created an environment where experimentation, rapid iteration, and disciplined execution work together. Collaboration amplifies innovation as well. When you have a team of highly intelligent, curious people challenging each other and combining their expertise, ideas develop more quickly and are scrutinized more rigorously. That process ensures that only the strongest, most robust concepts are put into practice, and it accelerates the pace of discovery. Innovation isn't just about flashy new strategies. It's about incremental improvements, small adjustments, and continually refining your approach based on evidence. Even tiny changes, when applied consistently and rigorously, can have a huge impact over time. Ultimately, innovation is what allows you to maintain an edge in a constantly shifting landscape. Without it, past success becomes irrelevant. Markets are dynamic, and the ability to adapt, discover, and implement new approaches faster than anyone else is what enables sustained extraordinary performance. That mindset, curiosity, experimentation, embracing failure, and rapid iteration is what has allowed me and my team to achieve results that most people consider impossible. Discipline is something I can't emphasize enough. People often underestimate it, thinking that having a brilliant model or a powerful strategy is enough to succeed, but without discipline, even the best ideas can fall apart. I've always treated discipline as the framework that allows everything else, mathematics, innovation, collaboration, patience, to work effectively. It's what keeps you consistent, focused, and resilient, especially when markets get chaotic or unpredictable. One of the most critical aspects of discipline is sticking to the process. I've seen talented investors abandon their strategies because of temporary setbacks, fear, or greed. The market moves in ways that seem irrational at times, and without discipline, it's easy to make impulsive decisions that destroy long-term results. I trained myself and my team to follow the rules we established, to let the models guide our actions, and to avoid letting emotions interfere. That consistency compounds over time. Another part of discipline is knowing when not to act. It's tempting to jump on every opportunity to chase the next trend or to react to noise in the market, but successful investing is as much about restraint as it is about action. You have to wait for the conditions that match your strategy, trust your models, and resist the urge to second-guess yourself. That kind of discipline separates amateurs from professionals. Discipline also means rigor in testing and evaluating every idea. No assumption goes unexamined, no model is deployed without thorough stress testing, and every strategy is scrutinized from multiple angles. That level of rigor ensures that when you do act, you're making the best possible decision based on evidence, not impulse. Emotional control is a huge component as well. Markets can provoke fear, greed, excitement, and panic. And if you let those emotions dictate your actions, you will inevitably make mistakes. Discipline allows you to stay calm, to follow the process, and to make decisions rooted in reason rather than reaction. Another important aspect is the commitment to long-term thinking. Discipline is what allows you to stay the course even when results aren't immediately visible, to trust the compounding effect of small advantages, and to avoid chasing short-term gains at the expense of your overall strategy. I've also found that discipline is contagious within a team. When everyone is committed to the same rigorous standards, when rules are followed consistently, and when execution is precise, the entire operation functions like a well-tuned machine. That environment reduces errors, enhances learning, and maximizes results. One of the most common reasons people fail in investing is inconsistent application of their methods. They might have good ideas, strong analysis, or even innovative models, but if they lack discipline, those advantages are wasted. Discipline bridges the gap between potential and actual performance. It transforms theoretical success into real, measurable results year after year. Ultimately, discipline is what allows extraordinary performance to be sustainable. It doesn't guarantee results in the short term, but over time, it ensures that the strategies, models, and insights you've painstakingly developed are applied effectively without being undermined by emotion or impatience. It's the quiet force that turns intelligence into action and action into consistent success. And without it, even the most brilliant minds can fall short of their potential. One thing I've realized over the years is that compounding is more powerful than most people give it credit for, but it only works if you trust the process and follow it consistently. People are always chasing quick wins, looking for the next big trade, or trying to time the market perfectly, but that's not how extraordinary returns are achieved. Compounding comes from small, consistent edges applied over time, and the key to unlocking it is letting the system you've built work without interference. That's why I've always emphasized the importance of having a disciplined, repeatable process. Every decision, every trade, every strategy we employed at Renaissance was designed to be systematic, tested, and predictable in its behavior under a wide range of conditions. Once we had confidence in a model, we allowed it to operate, sometimes for months or years, without being distracted by short-term noise. Patience, discipline, and consistency make compounding possible. Another part of compounding is understanding the value of small advantages. People often assume that you need to hit a home run with every trade, that only enormous moves matter. But in reality, it's the accumulation of small, statistically significant advantages that produces extraordinary results. If you can identify a pattern that gives you a small edge and apply it repeatedly, over time that edge grows exponentially. That's the hidden power that most people overlook. It's also critical to avoid disrupting the process. I've seen talented investors abandon a strategy too soon because of a short-term setback or a temporary loss. That's the fastest way to destroy the benefits of compounding. You have to trust that your rigorous testing, data analysis, and models are guiding you correctly, even when the market behaves unpredictably. Confidence in the system allows you to ride out volatility without panic or rash decision-making. Compounding also depends on continuously learning and refining the system. It's not enough to set a strategy and leave it alone forever. You have to observe how it behaves in different conditions, identify areas of improvement, and incrementally enhance it. That iterative process ensures that the compounding effect grows stronger over time because the system itself becomes more efficient, more precise, and more robust. Another important factor is minimizing errors. Compounding works best when mistakes are rare and small. That's why discipline, humility, and rigorous testing are so critical. Every decision must be carefully considered and every model carefully validated. A single large mistake can wipe out months or years of progress, so the focus on precision is essential. Over time, as these small edges accumulate, you begin to see extraordinary results that look almost impossible from the outside. Most people don't notice it day to day because it happens gradually, but the effect is powerful and transformative. The compounding effect also reinforces good behavior. When you see consistent results from following a disciplined, data-driven process, it builds confidence in the system and encourages further adherence, creating a positive feedback loop. That's how consistency, patience, and a process you trust combine to turn small advantages into huge long-term gains. Ultimately, compounding isn't about luck, speculation, or trying to predict every market movement. It's about identifying measurable advantages, applying them systematically, and trusting the process over the long term. That approach, done correctly, is what allows extraordinary performance year after year, and it's the principle that underlies almost every successful strategy I've ever implemented. I've learned in investing is that success comes from finding order in chaos and letting that order guide your decisions. Markets are noisy, unpredictable, and full of random events, and if you try to react to every fluctuation, you'll end up making mistakes and losing focus. From the very beginning, I treated markets like a complex system to be understood rather than a game of chance to be guessed at. I looked for patterns, repeated behaviors, correlations, and inefficiencies that most people ignore. That approach allowed me to see structure where others only saw randomness. But spotting order isn't enough. You have to build systems that can exploit it consistently. That means designing models, testing them rigorously, and applying them with discipline. Chaos is everywhere, but structured thinking turns it into opportunity. Another key part of this is understanding the difference between noise and signal. The market throws off thousands of pieces of information every day, some meaningful, most meaningless. The challenge is to filter out the noise and focus only on what matters. That requires both mathematical rigor and mental clarity, and it's the foundation of making decisions that compound into extraordinary results. Recognizing patterns isn't about predicting the future perfectly. It's about identifying repeatable relationships that increase the probability of success. When you let those relationships guide your actions rather than emotion or instinct, you gain a significant edge. That edge is what allowed us to achieve results that most people considered impossible. Another lesson is that chaos exposes the limits of human intuition. People tend to overreact, chase trends, or assume that volatility equals risk. In reality, volatility is just part of the system. True risk is making decisions without understanding the underlying structure. By studying patterns, testing hypotheses, and building robust systems, you mitigate that risk and turn complexity into a competitive advantage. Finding order also requires patience and humility. You can't force patterns to exist where they don't, and you can't assume that every strategy will work immediately. You have to observe, analyze, test, and let the system reveal itself over time. That patient approach ensures that the insights you act upon are real and reliable, not illusions born of randomness. Collaboration amplifies this principle. By working with a team of highly skilled, curious people, we were able to see connections, uncover patterns, and refine models in ways I could never have done alone. Different perspectives, diverse expertise, and rigorous debate all contribute to a clearer understanding of the order hidden within the apparent chaos. Discipline ties it all together. Once you identify order, you must apply it consistently. That means trusting the models, following the rules, and avoiding emotional reactions when the market behaves unpredictably. Chaos will always be there, but disciplined execution ensures that the structure you've uncovered translates into consistent performance. Over time, this combination of observation, pattern recognition, rigorous testing, collaboration, patience, and discipline allows extraordinary results to emerge. What looks like luck from the outside is really the outcome of a carefully constructed system acting on order within the noise. Ultimately, the lesson is simple but profound. Don't be overwhelmed by chaos. Study it, understand it, find the hidden patterns, and let those patterns guide your actions. That mindset, more than any single strategy, more than any specific model or formula, is what has made sustained, extraordinary performance possible over decades. Looking back on everything I've learned, one thing is crystal clear. Achieving extraordinary returns isn't about luck, shortcuts, or some secret formula you stumble upon. It's about a mindset, a disciplined approach, and the willingness to see the world differently than most people do. When I started out, I didn't imagine that I would build a system capable of producing the results we eventually achieved. I simply approached the markets with curiosity, a desire to understand patterns, and a commitment to rigor. Over time, that mindset compounded just like any good strategy, and it led to outcomes that to many seem impossible. I want to be honest about something. None of this comes easy. It requires patience when the results aren't immediate, humility when your models fail or your assumptions are challenged, and relentless discipline to stick with the process, even when temptation and fear are screaming at you to act differently. It's uncomfortable at times, and it often goes against our natural instincts. Most people want quick rewards. They want to feel in control, or they rely on intuition to guide every decision. But intuition is often misleading, and chasing immediate results can destroy even the most brilliant strategy. The real work is quiet, behind the scenes. It's testing models, analyzing data, observing patterns, and refining approaches continually. It's collaborating with people who challenge your thinking, listening to perspectives that make you uncomfortable, and constantly asking, what am I missing? That constant questioning is what prevents mistakes and keeps performance sustainable over decades. Another critical point is that extraordinary results require respect for the limits of knowledge. I don't know everything, and I never have. That's why humility is so important. The moment you think you know more than the system or more than the evidence suggests is the moment you expose yourself to risk. Accepting that there will always be uncertainty, that no model is perfect, and that markets can surprise you allows you to act deliberately rather than impulsively. And patience cannot be overstated. Compounding works over time, and it works best when you allow small, consistent advantages to accumulate without interference. You have to trust the process, even when progress is slow or invisible to the naked eye. Innovation and curiosity also play a massive role. The world is always changing, patterns evolve, and the moment you stop experimenting, you stop gaining an edge. Constantly asking questions, testing new ideas, and adapting faster than the market is what separates sustainable success from fleeting luck. Finally, discipline ties it all together. Without it, curiosity becomes chaos, patience becomes passivity, and knowledge becomes arrogance. Discipline ensures that every insight, every model, every pattern you uncover is applied consistently, systematically, and intelligently. It allows you to act when opportunities are present, to hold steady when the world is volatile, and to convert small edges into extraordinary outcomes over time. So if there's one thing I want you to take away, it's this. There are no shortcuts to exceptional results. You won't find a magic trade, a lucky formula, or a secret tip that guarantees success. What you can do is develop a mindset that combines curiosity, discipline, humility, patience, and a respect for the underlying mathematics of the world. Build a team smarter than yourself, test your ideas rigorously, innovate relentlessly, and let small advantages compound over time. That approach won't just improve your investing, it will transform the way you think about complex systems, decisions, and opportunity in any part of life. Extraordinary performance is available to those who commit to the process, who embrace challenges, and who persist where others quit. It's not easy, but the rewards, both in results and in the clarity it brings to how you see the world, are worth every ounce of effort. And that, more than any single strategy or model, is the principle that has guided me. And it's the principle I hope inspires anyone watching this to think differently, act deliberately, and pursue excellence in every endeavor they choose.